The economy hasn't been growing as quickly as the Fed had anticipated, with 1.7% of GDP growth in the second quarter, following 1.1% in the first quarter of 2013. U.S. labor market's recovery has slowed further in July, with an addition of only 162,000 jobs, many of which are low-paying jobs, bringing the unemployment level to 7.4%. The good news is that investors feel that the number is low enough to convince the Fed not to begin scaling back its bond buying program in September. The 10-year Treasury rate has been through a roller coaster ride since the Fed first hinted of its intentions to do so. The rate spiked 66% from 1.63% to 2.72% in 20 days. As of August 2nd, the rate stood at 2.63%. The Fed clarified that it will not raise interest rates until 2014 or 2015, when unemployment is expected to reach 6.5%. Other economic indicators support this estimate. Although the rate of job creation is well below the monthly average of 202,000 during the first half of 2013, the job market added an average of 179,000 jobs per month for 31 straight months. The economy is still on track to add about 2.5 million jobs this year, and unemployment levels could reach 7% by year end. Other indicators show that the economy appears to be gaining momentum as consumers boost spending, companies add to payroll, consumer confidence reaches 84.1%, its highest level since 2007, and more. We are clearly in the fourth year of recovery. The housing markets, equities, and credit markets are all demonstrating that the economy has the strength to grow and accelerate at a much faster pace. Housing prices have increased 12.2% year over year, the largest increase since 2006, and construction starts have increased by 28% in 2012. As long as the interest rates remain in low territory and the job market sparks new demand, the housing sector will continue to be a powering factor, as the multiplier effect of the housing recovery is huge. Capital markets. The Fed has tripled its holdings since 2008 to $3 trillion of treasuries and mortgage-backed securities. As this money trickles down and enters the economy, there is a high probability of upward pressure on the 10-year Treasury and interest rates. Expect to see the Treasury rising towards 4 to 5% in 2014 and 2015. As long as the spike in interest rates does not create any further turmoil, commercial mortgage originations are expected to grow at 11% in 2013 to $254 billion by year end. CMBS issuance saw a 48% increase last year to $55 billion and is expected to grow to $90 billion by year end. CMBS is dominating the secondary and tertiary markets and will loan up to 75% LTV. Rates on a 10-year term are between 230 and 250 basis points above the 10-year swap. All-in CMBS rates are between 4.5% and 5.25%. Life companies closed 18% more loans last year and have increased their real estate allocations by 15% and will loan up to 75% LTV. Rates on a 10-year term are between 3.7% and 4.9%. Banks remain conservative, but many offer non-recourse financing to strong borrowers with a 3 to 5 year term in anticipation of continued rising interest rates. Recourse loans with a 10-year term for Class A neighborhood and community centers are around 250 to 350 basis points above LIBOR, which translates to all-in rates of 5% to 5.5%. National Retail Outlook. Sales volume in the second quarter posted a robust volume of $13.5 billion and a 50% increase from the first quarter, and a total 9% gain year over year. Single-tenant retail saw a 98% jump. Cap rates across all retail products have remained relatively stable, but the volume and cap rates have yet to be affected by the recent spike in interest rates. The impact will be felt in quarter 3 and quarter 4 this year, but with a national average cap rate for all retail at 7.1%, investors still have a reasonable spread to absorb some of the increase in interest rates. The Southeast region average cap rate for all retail is at 7.5%. Anchored retail centers cap rate average is at 7.4%, and unanchored average is at 7.7%. The level of distressed retail loans declined 12% year over year. 65% of retail distressed loans have been worked out. Retail continues to be the best performing sector in 2013 as shopping centers posted another gain of NOI income, rising 5.5% since the first quarter of 2012. Neighborhood centers increased 6.8%, and power centers increased by 7.7%. Vacancy in shopping centers fell by 30 basis points year over year to 10.7% average, while rents have increased by only 0.5%. Retail development is still at historic lows, which will help further reduce vacancies and increase rents in 2013 and 2014. Investment continues to flow into higher-yielding secondary and even tertiary markets. Two forces are currently impacting retail demand: the economy and e-commerce. This has caused stiff competition for mid-price hard goods retailers, and they are all in an extremely conservative growth mode, if any growth at all. Dollar stores, discounters, and off-price retailers continue to thrive, as well as luxury and high-end stores. Grocery stores and restaurants lead the strongest bricks-and-mortar growth. Restaurants will account for 42% of new retail units in 2013. Other growing sectors include home-related, pet and farm, and sporting goods. The biggest losers are apparel, books, cards, gifts, cellular stores, consumer electronics, and office supply. Big box retailers are mostly shrinking footprints, especially electronics, books, and office supply chains. All tenant mixes are shifting away from hard goods and looking to create an environment around entertainment and dining options. Class A shopping centers in every U.S. market is strong, and traditional neighborhood centers continue to be healthy. But there hasn't been enough demand for Class B outside of core markets. Class C struggles everywhere. Strongest retailers have been impressive year-over-year sales growth this quarter, such as Costco, 5%. Belk, 5.8%, Nordstrom, 6.3%, Ross, 5%, TJ Maxx, 7%, Whole Foods, 6.9%, Cabela's, 24%, and PetSmart, 4.6%. Weaker retail saw sales declines, such as JCPenney's, 31.7%, Barnes & Noble, 7.3%, H.H. Gregg, 9.7%, Office Depot, 5%. Office Max, 4.6%. Staples, 5%. Kroger, the nation's largest grocery store chain, is getting stronger with the acquisition of Harris Teeter. The chain now operates 2,631 stores in 8 Southeast and Mid-Atlantic states. E-commerce is changing the retail marketplace dramatically. The number of Internet users worldwide has jumped from 1 billion in 2000 to 2.5 billion today and continues to grow rapidly, many thanks to smartphones and tablets. The good news is, even though Apple, Netflix, Amazon, eBay, and other online giants killed the record stores and video rentals and are in the process of doing the same to electronics and bookstore big boxes, e-commerce will never replace the bricks-and-mortar shopping experience. Most retailers are attacking this head-on by shifting focus and heavily investing in their omni-channel platforms, IT and logistics, same or next-day delivery, order online, up at the store strategies, and more. By doing so, retailers like Target, Macy's, Nordstrom's, Walgreens, The Gap, Abercrombie & Fitch, Coach, Foot Locker, Macy's, Michael Kors, Office Max, Office Depot, Merged Company, Kay's and Jared Jewelry Chains, Tiffany, Urban Outfitters, Staples, Walmart, and Williams-Sonoma will be able to compete with Amazon in the digital world. Affected by e-commerce, many Staples-oriented tenants are being replaced by formerly prohibited users such as massage spas, motor and scooter shops, but the most notable ones are medical-related, healthcare, radiology, and dialysis centers, etc. The most active retail investment markets in the U.S. during the first half of 2013 reflect a considerable re-ranking, which provides that more capital is flowing into secondary markets such as Tampa, 5th, Las Vegas, 3rd, Atlanta, 9th, and Orlando, 20th. Orlando MSA. The Orlando Kissimmee MSA is comprised of Lake, Orange, Osceola, and Seminole counties and is home to many tourist attractions such as Walt Disney World, Universal Studios, SeaWorld, Kennedy Space Center, which make this city the #1 tourist destination in the world. The MSA population, 2,171,360. Population growth estimate, 1.9%, the second highest in Florida. Unemployment, 6.6%. Employment growth estimate, 1.9%. Average HH income, $95,316, compared to $123,440 for the top metros in U.S., according to Moody's. Orlando's recovery proceeds. Investors have many reasons for optimism thanks to the ever-expanding tourism industry serving over 57 million visitors a year, one of the busiest airports in the world, the growth of Medical City, the second largest university in the country, the Sunrail project, and more. Moody's forecast for Orlando's population growth in 2013 is 2.4%, more than double the rate of the growth projected for the nation. The leisure and hospitality sector gained 6,800 jobs in April, 3.2%, but the construction sector, on the other hand, contracted by 1,700 jobs, 3.9%. Construction employment is expected to increase again thanks to the spike in building permits. Unemployment rate is at 6.7%, down from 8.7% last year. Moody's reports that the average household income for the Orlando MSA is at $95,492 compared to the average of $125,227 for the nation's top metros. The housing market sees a strong recovery trend that has outperformed most other metropolitan areas in Florida in terms of home sales, inventory reduction, and median price. In March, the median sales price was up 22.3%, and pending sales were up 23.4% year over year. The first 4 months of 2013 saw 5,707 new home building permits, almost a 103% increase from last year. The sharp comeback of the housing market is expected to contribute to the stability of the retail market in coming quarters. The lack of new development in the retail sector also contributes to vacancy reduction. Shopping center net absorption is finally positive 93,000 square feet in April, first time in 5 years. Shopping center vacancy, though, is still at 13.6% in the first quarter, down 40 basis points from the last 2 quarters. Year-end 2013 expectations is for a 13.4% vacancy rate. Asking rents are at 17.5% on average, and effective rates at $14.98 per square foot. Only 3 projects totaling 137,000 square feet will be completed by year-end. Power center vacancy for the first quarter is at 8.4%, above the national average of 5.8%. Asking rent is at $24.15 per square foot, up 1.2% year over year. The residential development acceleration throughout Orlando, and especially in the booming Lake Nona area, will probably create more retail development activity. Also, the new Sunrail consumer rail line should become a significant factor in retail real estate in the period ahead. Transactions. Orlando. The shopping center market in the Orlando MSA consists of 1,357 projects with 63,439,698 square feet. Sales activity of neighborhood and community shopping centers in 2013 was up compared to 2012. In the first half of 2013, 19 transactions of strip centers closed with $173.9 million in sales volume, an average price of $87 per square foot, and an average cap rate of 8.3%. For all retail types of properties, Orlando's sales volume has increased by 94% year over year, which ranks Orlando as the 20th best performing retail market in the country in the first half of 2013. Tampa. In the first half of 2013, 11 transactions of strip centers closed with $128.2 million in sales volume, an average price of $147 per square foot, and an average cap rate of 8.4%. For all retail property types, Tampa's sales volume has increased by 377% year over year, which ranks Tampa as the fifth best performing retail market in the country in the first half of 2013. The Tampa-St. Petersburg-Clearwater MSA is comprised of Hernando, Hillsborough, Pasco, and Pinellas counties. Located on the west coast of Florida, the region includes one of the busiest ports in the southeast: Tarpon Springs, Ybor City, Busch Gardens, University of South Florida, and the University of Tampa, and many tourist attractions. The MSA population is at 2,824,724. Population growth estimate 1.3%. Unemployment is at 8.2%. Unemployment growth estimate is 1.9%. Average HH income, $96,882. Tampa is steadily putting the recession behind her. As of April 2013, the total non-farm employment is up 3.1% from last year. Services, trade, construction, and leisure and hospitality sectors are all experiencing growth again. Unemployment rate in March was 6.9%, down from 9.1% last year. Moody's reports an average household income of $98,315 compared to an average of $125,227 for the top metros in the nation. The housing market shows a strong demand. March 2013 had the strongest sales activity in the Tampa MSA in 7 years, with 3,100 transactions completed. Prices are up an average of 22% year over year, and about two-thirds of transactions were traditional sales. However, one must keep in mind the worrisome trend of hedge funds' bulk acquisitions of REO as investment properties. Pre-recession employment level should continue. The community and neighborhood sector shows positive signs lately. The lack of new supply has helped absorption and vacancy rates. Net absorption in 2012 was positive 206,000 square feet. In the development world, all is quiet. Aside from a handful of projects that remain in the pipeline, such as Grove at Wesley Chapel, a power center, and a regional center under construction in the eastern part of Hillsborough County, the activity is very low. One center of 35,000 square feet in the West Shore area was completed in March of this year. Vacancy ended up at 11.8%. Down 40 basis points year over year. Asking rents are at $14.27, and the effective rates are at $12.49 on average, following an increase of 1.5% in 2012. Power center vacancy rate is at 5.9%, similar to the national average. Mean asking rental rate for the power center is at $22.83 per square foot, up 1.5% year over year. Sean Glickman, Managing Director of the Glickman Retail Group, is a real estate strategic advisor and a shopping center expert in Florida. We are experts in institutional-grade investment services. As your objective advisor, our primary focus is to help you make the most effective investment decisions. Working with our team, you will maximize the value of your assets and create wealth for you and your investors.